Something is happening in the gold market right now, and almost nobody in mainstream financial media is talking about it seriously. Gold just hit record highs. Not marginally, not technically. We are talking about prices that have never existed in the entire history of human civilization. Gold has been used as money for 5,000 years. Kings fought wars over it. Empires were built on it. And right now, it is trading at levels that would have seemed impossible just 3 years ago. But here is the part that should stop you cold. The stock market is near all-time highs too. Both things are true simultaneously. And that combination, gold surging while stocks celebrate, has only happened a handful of times in modern financial history. Every single time it has happened, one of them was wrong. One of them was lying. And the consequences for investors who bet on the wrong one were catastrophic. So which one is telling the truth right now? The stock market that is pricing in endless growth, soft landings, and AI-driven prosperity, or gold, the asset that has no earnings, pays no dividend, produces nothing, and yet is screaming louder than it has ever screamed before? Stay with me, because by the end of this video, you are going to understand exactly what gold is signaling, why the stock market has not heard it yet, and what history says happens when it finally does. This is not a story about a shiny metal. This is a story about what happens when the financial system starts to crack, and only one asset tells the truth before everyone else figures it out. Let us establish exactly what we are dealing with here. Gold is not a speculative asset in the traditional sense. It does not have a CEO. It does not release quarterly earnings. It cannot be printed, duplicated, or created by a government decision. There are approximately 200,000 metric tons of gold ever mined in all of human history. That is it. That is all there is. And because of those properties, gold has functioned for 5 millennia as the purest signal of what sophisticated money actually believes about the stability of the financial system around it. When gold rises slowly and steadily, it is whispering. When gold rises at the pace it is rising right now, it is screaming. In the past 2 years, gold has risen over 60%. In the past 5 years, it has nearly doubled. And in the past 12 months specifically, it has broken record after record after record, with a persistence and velocity that professional traders are describing as unlike anything they have seen in decades. Central banks are buying gold at the fastest pace since 1967. Not one central bank, not two, dozens of them simultaneously across multiple continents, buying physical gold and moving it into their own vaults at a pace that is breaking every modern record. Now ask yourself a simple question. Central banks are the most informed, most connected, most data-rich financial institutions on Earth. They have access to information that no retail investor, no hedge fund manager, no financial journalist will ever see. They know things about the state of the global financial system that are classified. And right now, they are buying gold like their survival depends on it. What do they know? That is the question this entire video is built around, and the answer is hiding in plain sight if you know where to look. Here is the comfortable story the financial media tells about gold right now. Gold is rising because of inflation fears. Gold is rising because of geopolitical uncertainty. Gold is a safe haven, and people are nervous. Nothing unusual, nothing to worry about. The stock market is still healthy, earnings are still strong, the economy is still resilient. Gold is just being gold. Move along, nothing to see here. But that is only half the story. Because when you actually dig into the data, when you look at who is buying gold, how they are buying it, where they are moving it, and what they are simultaneously doing with their dollar-denominated assets, a completely different picture emerges. This is not a safe haven trade. This is a restructuring trade. And here is where things get really interesting. For decades, the global financial system has operated on a specific foundation. The United States dollar is the world's reserve currency. Countries hold dollars. They trade in dollars. They price oil in dollars. They hold U.S. Treasury bonds as their primary reserve asset. The entire architecture of global finance is built on the assumption that the dollar is the most trustworthy store of value on Earth. Gold has been quietly, and then not so quietly, challenging that assumption. The real signal is hidden in what happened next. After the United States and its allies froze Russia's foreign currency reserves in 2022, effectively locking $300 billion of Russian government assets and making them inaccessible overnight, something changed in the calculations of every central bank on Earth. Every country that was not a close U.S. ally looked at what happened to Russia and thought the same thing at the same moment. If it can happen to them, it can happen to us. And they started buying gold. Not because they are afraid of inflation, not because they are worried about stock market volatility, but because gold is the only major reserve asset in the world that cannot be frozen, cannot be sanctioned, cannot be turned off by a decision made in Washington. Gold is the asset that exists outside the system. And right now, the people who run the global financial system are quietly moving their reserves into the one thing that protects them from that very system. Now connect the dots. Let us talk about what is actually happening to the gold price and why the magnitude matters. Gold crossed $2,000 per ounce for the first time in history in 2020. That was a milestone. That was historic. Financial media covered it extensively. Then it crossed $2,500, then $2,600, then $2,700. Each new record came faster than the last. The acceleration of the price move is itself a signal separate from the price level. Here is why that matters. In financial markets, the speed of a price move often tells you more than the direction. A slow, steady rise in gold over many years suggests gradual shifts in sentiment. Modest concerns accumulating over time, but a rapid acceleration, a vertical move that breaks record after record with barely a pause, suggests something different entirely. It suggests urgency. Someone, or more accurately, many someones, are buying gold with a sense of urgency that is overriding normal price sensitivity. They are not waiting for a dip. They are not scaling in slowly to minimize market impact. They are buying now, at record prices, which means they are more afraid of not having gold than they are of paying too much for it. Think about that psychology for a moment. When you buy something at its all-time high price, and you are not bothered by that fact, it means you believe the alternative, not having it, is more dangerous than the price risk of owning it. That is not a trade motivated by greed. That is a trade motivated by something much more primal. And simultaneously, while gold is doing this, the US stock market is also near all-time highs. The S&P 500 is pricing in continued prosperity, stable growth, and a soft landing for the economy. Corporate earnings estimates remain optimistic. Analyst price targets keep climbing. Both of these things cannot be correct simultaneously. Gold at all-time highs says the world is facing serious structural stress. Stocks at all-time highs say everything is fine and getting better. One of these markets is misreading the situation. And history gives us a very clear guide to which one tends to be right when they diverge this sharply. This is the section that changes how you see everything else. Gold does not rise in isolation. It rises in response to something. And to understand what it is responding to right now, you have to understand the three forces that drive gold prices at a fundamental level. The first force is real interest rates. When real rates, meaning interest rates adjusted for inflation, are high and positive, gold struggles. Cash and bonds compete with gold effectively because they offer real returns. When real rates fall or turn negative, gold surges because holding cash becomes genuinely costly in purchasing power terms. The second force is dollar strength. Gold is priced in dollars globally. When the dollar strengthens, gold tends to weaken in dollar terms. When the dollar weakens, gold rises. The third force, and this is the one most people overlook, is systemic trust. The baseline level of confidence that the global financial system is stable, that contracts will be honored, that reserve assets will remain accessible, that the rules of the game will not suddenly change. Here is what makes the current gold move so extraordinary and so alarming. Gold is rising despite the dollar remaining relatively strong. Gold is rising despite real interest rates being positive. Both of those forces should be headwinds for gold. Both of them are pushing against the price, and gold is still going up, which means the third force, systemic trust, is collapsing so rapidly that it is overwhelming both of the traditional headwinds simultaneously. That has only happened twice before in recent memory. Once in the 1970s during the collapse of the Bretton Woods system, when Nixon ended dollar convertibility to gold, and the entire post-war monetary architecture unraveled. And once, in the years leading up to and including the 2008 financial crisis, when trust in the banking system itself collapsed. Both of those periods were followed by economic and financial disruptions that reshaped the global order. Gold was telling the truth both times, while the stock market was still telling comfortable stories. And right now, gold is telling a story again. The story is this: confidence in the current monetary system, the dollar-centered, U.S. Treasury-backed, globally integrated financial architecture built after World War II, is fracturing. Not collapsing overnight, not ending tomorrow, but fracturing. Slowly at first, then faster, in ways that are showing up in the gold price before they show up anywhere else. Now we go deeper. This is the part that the financial media is almost completely ignoring. The gold move is connected to something that should be the biggest financial story in America right now, but is being systematically underreported. The United States national debt just crossed $36 trillion. The annual interest payment on that debt, just the interest, not paying down a single dollar of principal, now exceeds $1 trillion per year. $1 trillion, every year, just in interest. To put that in human terms, the United States government is now spending more money servicing its debt than it spends on Medicaid, more than it spends on all discretionary programs combined outside of defense. The interest bill alone now rivals the entire defense budget. And here is the part that makes sophisticated global investors deeply uncomfortable. There is no realistic plan to bring this under control. Not from either political party, not from any credible legislative proposal currently being debated. The trajectory of American debt is not a partisan issue. It is a mathematical reality that continues regardless of who wins any election. Now here's the connection to gold that nobody is drawing explicitly. When a country's debt load becomes so large that the market begins to question whether the debt can ever be genuinely repaid, not defaulted on explicitly, but inflated away through monetary expansion, the price of gold rises. Because inflation is the hidden default. When a government cannot pay its debts in real terms, it does not announce bankruptcy. It prints money. It devalues the currency. It pays back 100 cents on the dollar nominally, while those dollars buy 50 cents worth of goods. Gold is the protection against that outcome. And the fact that gold is rising at this pace, at this moment, while U.S. debt is at these levels, while the Federal Reserve is caught between inflation and growth concerns, suggests that sophisticated global money is beginning to price in a scenario where dollar debasement becomes not just possible, but probable. But then something happened that made this even more significant. Foreign governments, including some of America's longest-standing economic partners, began quietly reducing their holdings of U.S. Treasury bonds. Japan, China, Saudi Arabia. Country after country has been trimming their Treasury exposure. Not dramatically, not in ways that trigger headlines every day, but consistently, persistently, in one direction. They are selling the thing that is supposedly the world's safest asset, and they are buying gold. The picture becomes impossible to ignore. Let us go to the historical record, because this is not unprecedented. And history is very specific about what tends to follow this kind of gold signal. In the early 1970s, gold was legally fixed at $35 per ounce under the Bretton Woods Agreement. Nixon ended that convertibility in 1971. Gold was freed to find its market price. Over the next 9 years, it rose from $35 to $850 per ounce, a 24-fold increase. During that same period, the stock market, in real terms, adjusted for the inflation that accompanied the monetary disorder, was essentially flat or negative for years. The investors who understood what gold was signaling in 1971 and positioned accordingly experienced one of the greatest transfers of wealth in modern history. The investors who stayed fully invested in stocks because everything looked fine on the surface watched their real purchasing power erode for nearly a decade. In 2005 and 2006, gold began rising with unusual persistence. Financial analysts explained it away. The stock market was booming, housing was strong, the economy was growing. Gold was just a commodity trade, nothing important. By 2008, the financial system nearly collapsed entirely. Gold had been right. The stock market had been catastrophically wrong, and the investors who had listened to the gold signal had preserved wealth that others lost entirely. Now we are here. 2024 into 2025. Gold is once again rising faster than almost any mainstream analyst predicted. The stock market is once again near all-time highs. The mainstream narrative is once again explaining away the gold signal with comfortable, partial explanations. History does not repeat exactly, but the rhyme right now is deafeningly loud. That alone would be important, but there is more. Because this time, the scale of the underlying imbalances, the debt, the geopolitical fragmentation, the dollar credibility questions, the central bank buying, is larger than in any previous episode, which suggests that if gold is right this time, the eventual repricing of risk assets could be larger than anything in the modern financial era. Let us talk about what the people with the most to lose are actually doing, not what they are saying in public, what they are doing with real money. Central banks globally purchased over 1,000 tons of gold in 2023. They are on pace to match or exceed that in 2024. This is the highest sustained pace of central bank gold buying since the collapse of the Bretton Woods system in the early 1970s. These are not emotional buyers. These are institutional buyers with 100-year time horizons and the most sophisticated economic analysis available to any organization on Earth. They are buying gold. Ray Dalio, founder of Bridgewater Associates and manager of the world's largest hedge fund for many years, has been publicly and explicitly warning about the risks of holding dollar-denominated debt assets. He has written extensively about the debt cycle and the historical pattern of reserve currency decline. He has been increasing commodity and gold exposure. Paul Tudor Jones, one of the most successful macro traders in history, stated publicly that he would not own fixed income assets right now. He specifically called out the fiscal situation in the United States as unsustainable. He expressed preference for gold as a store of value in the current environment. John Paulson, the man who made billions correctly betting against the mortgage market in 2008, has been a consistent and vocal advocate for significant gold allocation as a hedge against monetary debasement. These are not gold bugs. These are not perma-bears. These are people who made generational fortunes by reading macro signals correctly and positioning ahead of the crowd. And the direction of their positioning right now shares a single common thread. They are reducing exposure to the paper financial system and increasing exposure to the asset that exists outside of it. Meanwhile, the retail investor in America is at near record levels of equity exposure. The average American with a retirement account is more concentrated in stocks, and specifically U.S. stocks, than at almost any point in modern history. The home bias is extreme. The cash allocation is minimal. The alternative asset exposure is almost non-existent. The gap between what sophisticated money is doing and what retail money is doing has rarely been wider. And that gap historically resolves in one direction only. Here is where we make this real for you. Because the most important finance content is not the content that sounds impressive. It is the content that changes how you make decisions. The first lesson is this. Price is information. When an asset with a 5,000-year track record of reflecting monetary stress reaches all-time high prices with the velocity and persistence that gold is currently displaying, that is information. You do not have to act on it immediately, but you should not ignore it. Information ignored is opportunity lost, and sometimes catastrophe invited. The second lesson is this. Diversification is not just about different stocks. Most American retail investors think they are diversified because they own 500 stocks through an index fund. But if all 500 of those stocks decline simultaneously during a genuine monetary or financial system stress event, and they will, because they are all priced in the same currency and subject to the same systemic risks, then owning 500 of them instead of 10 provides no real protection at all. Real diversification means owning assets that respond differently to the same macroeconomic events. Gold is one of those assets. The third lesson is this. You do not need to predict the exact timing to benefit from the signal. You do not need to know when the stock market corrects. You do not need to know when the dollar weakens meaningfully. You do not need to predict a specific crisis on a specific date. You need only to understand that the signal exists, that it has historical precedent, and that positioning ahead of the crowd, even imperfectly and even early, has historically been far more profitable than reacting after the fact. The fourth lesson is this. The narrative always sounds convincing until it does not. Right now, the dominant narrative is that AI will drive productivity gains that justify current valuations, that the Federal Reserve will navigate a perfect soft landing, that American exceptionalism makes dollar assets uniquely safe. These narratives may be partially true, but narratives do not protect you when the underlying reality diverges from them sharply enough. Gold does not care about narratives. It responds to reality. And right now, reality and narrative are diverging in ways that history suggests will eventually be resolved violently in price terms. The fifth and final lesson. Preparation is not pessimism. Understanding risk is not the same as predicting doom. The smartest investors in the world are not moving toward gold because they want the world to fail. They are moving toward gold because they understand that markets cycle, systems evolve, and the investors who survive generational transitions are the ones who never assumed the current arrangement was permanent. Nothing in financial history has ever been permanent. Not the Roman denarius, not the Spanish real, not the British pound as the world's reserve currency, not any system in any era. The question is never whether things change. The question is whether you are positioned when they do. Here is what gold is telling us right now. It is telling us that the people with the most sophisticated understanding of the global monetary system are losing confidence in the current arrangement at a pace that is accelerating. It is telling us that the dollar's unchallenged dominance as the world's reserve currency is no longer an assumption that every major central bank accepts without question. It is telling us that the debt trajectory of the United States has crossed a threshold where serious institutional money is seeking protection that exists outside the dollar-denominated financial system. It is telling us that the stock market's optimism may be real, but it may also be the last chapter of a story that gold has already finished reading. The stock market is a great mechanism for pricing near-term earnings expectations, but it is a poor mechanism for pricing systemic risk, monetary disorder, and the slow fracturing of long-held assumptions about how the financial world works. Gold is a terrible mechanism for pricing earnings, but it is an extraordinary mechanism for pricing exactly those systemic risks that the stock market consistently ignores until it is too late. Right now, gold and stocks are telling completely different stories about the world. In every previous historical episode where this divergence became this extreme, one of them was eventually proven catastrophically wrong. The gold market has a 5,000-year track record. The current bull market narrative has a few years. You decide which one deserves more of your attention. A major shift is happening. It is happening slowly enough that most people are missing it entirely. And it is happening fast enough that the window to position ahead of it may be shorter than it appears. Pay attention to what gold is saying, because by the time the stock market hears it, it may already be too late to respond. This video is for educational and informational purposes only. It is not financial advice. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. Gold and all investments carry risk, including the possible loss of principal. If this video made you see the gold signal differently, drop a comment right now. Tell me whether you think gold is right or whether the stock market is right. I read every single comment, and your perspective genuinely matters to this channel. If you are not subscribed yet, hit that button now, because the next video covers something even more significant that is hiding inside the gold move that almost nobody has connected yet. And share this with one person in your life who has money in the market and has not been paying attention to what gold is doing. They need to see this.